Hey everybody, this is Ellman, the blue-collar investor, with today's covered call writing question of the day. And today's question actually comes from many of our members who asked about calculating final returns after the trade has been completed. So to address this issue, I decided to go into the Schedule D of the elite version of the Ellman calculator. Now, as you can see on this screenshot in front of you, in the Introduction tab of the Schedule D, there are 6 tabs, D1 through 6. Well, 3 of those tabs, D2, 3, and 4, represent possible covered call writing scenarios. So let me read them to you. D2 states, I bought a stock, sold the covered call, and the stock was called away. That's the one we'll be discussing in today's video. D3, I bought a stock, sold the covered call, and bought back the option. And D4, I bought a stock, sold a covered call, and the option expired worthless. So those are the 3 covered call writing scenarios. And now let's compute D2, I bought a stock, sold a covered call option, and the stock was called away. And let's set up a hypothetical trade using Home Depot as an example. And Home Depot happened to be a stock on our premium watch list at the time that I produced this video. So in this hypothetical trade, we buy 100 shares of Home Depot at $69.50. We sell the May $70 call option, out of the money call option, for $1.40, or about a 2% 1-month return. And on expiration Friday, Home Depot was trading at $72. So we know that if we take no action, the shares will be sold the day after expiration Friday for $70. On the left side of the spreadsheet, we enter our stock trade. You can see we purchased 100 shares, and the cost basis was $69.50, and the sale price was $7,000, 70 times 100. Now on the right side of the spreadsheet, we enter the option trade, and you can see here that the acquisition date of the option is actually after the sale date, because when we write the call, we sell to open. So we sell initially before we actually technically acquire that option. So the date that the option is acquired is the date that it was exercised, 4/19, but the sale date is the date that we sold the covered call option, which was actually March 18th. And the price, of course, was $140. So once that information is entered in the blue cells of the spreadsheet, we then turn to the right page, or the white cells, where the following calculations will occur. You could see the total sales comes to $7,140. $7,000 from the sale of the stock and $140 from the sale of the option. Our cost basis is $69.50. So we have a capital gain of $190. Because this occurred in 1 month, it's a short-term capital gain, and that's what the S represents on the spreadsheet. Now, looking down to the bottom of the spreadsheet, we see that the Schedule D will actually add up all the columns for us. Now, here we have only the one trade, but what it's going to do is grand total all of the sales and cost basis, and it will break it down into short-term and long-term capital gains. So what you could do then is print out the spreadsheet and give it to your tax advisor at the appropriate time, and he'll really thank you for having this information. But it's also a way of calculating your capital gains and losses as you use this covered call writing strategy. So there you have it for one of the 3 covered call writing scenarios. I'll be producing 2 more videos along these lines for the other 2 D3 and D4 tabs. Now, for those of you who are premium members of the Blue Collar Investor, you can access the Schedule D spreadsheet from the elite version of the Ellman calculator, and it's located in the resources download section of the premium site. Those of you who are not premium members, we do have that elite version of the calculator available at the Blue Collar store. So there you have it, folks, how to calculate covered call writing returns after the trade is complete. Part 1 of a 3-part series I thank you so much for viewing this video. I hope you found it helpful. And as always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.